Hi there, welcome to the Rain Channel. In addition to the Rain It In segments that JG and I do, where we do an overview of what's happening economically and hit on some of the key issues, I thought I'd try a couple of different segments where I share with you the latest and greatest in headlines, kind of my analysis on what's going on, and see if that could be helpful for you in terms of the decision making you go through if you're investing in real estate, doing some things in business, and understanding what goes on behind the curtain, or in this case, behind the headline. We are hit today with a headline that says Canada added 150,000 jobs last month, which is 10x what the Economists had forecast, which is really interesting when you think about it, isn't it? How could that many economists get it that wrong? And what does it actually mean to us as investors or business people? What does it really mean when we miss it by that much? Well, the initial reaction is, oh my gosh, based on what the Bank of Canada has said, what Tiff Macklem has stated, it means that inflation is probably going to continue and that interest rates are going to continue to rise. And now what are we going to do? And now we have to deal with this. And already the cost of living is high. And given the cost of housing is made up of an interest payment, how do they even balance all that out? So let's just slow it all down. Let's take a look at what's behind the curtain and look behind that headline. Canada added 150,000 jobs. But when I look at that, we have to look at what's behind the headline. That is really how we can come up with an analysis. Now, when we're looking at what's happening economically, I look at the long-term real estate success formula. And when you look at the long-term real estate success formula, you take into consideration GDP growth, you look at jobs, you look at population growth, and then of course what that does is creates rental demand, and then rent increases or decreases, and eventually it leads to property price increases based on supply and demand. Now, I won't go down too much deeper on that, but when we look at job growth and we start to consider what that means to us economically, we then can start to create a thesis, if you will, a thought process, so that we can make decisions based on the possibilities and even the probabilities. As I said, many are suggesting that now that we've got this kind of job growth, Tiff Macklem is going to be forced to actually increase rates, given that he said that one of the things he has to do is slow down employment. But we have to look behind the headline, as I said. So when we look at the numbers behind the headlines, what do we start to see? First, we see that we break down by industry where that employment existed. And when we look at where the employment existed, you have 58, I'll call it 59,000 wholesale and retail jobs. And if we skip healthcare and social services, we see educational services. I want to go back to that. But we get into accommodations and food services. So now we're up about 70,000 jobs were of a lower paying job. Now that's the point I wanted to make. They're lower paying jobs. Now that's point one. Point two is if we go back up, we look at healthcare and social assistance, educational services. These are all on this chart, educational services. And then of course, other services. The point is that the majority of jobs that we have in that container are actually non-productive jobs, different than the good news, which was some higher construction jobs, where we saw in the construction industry almost 16,000 jobs. That's good news. But that speaks to productivity. Why does that matter? Because that's what drives gross domestic product, that GDP growth that we need so desperately. When we look at the administrative type jobs like a healthcare and social assistance, educational services, well, those are generally pretty good paying jobs. They aren't driving our GDP. They don't really directly support the productivity of the country, and that's what we want to pay attention to in terms of GDP growth. Now, this may seem a little convoluted. Follow along and I'll get to it. The point is this, is when you have low-paying jobs like we see in the wholesale and retail trade, as well as the accommodation and food services, what we see is that those individuals don't really generate enough additional income or discretionary revenue, discretionary income to actually go out and buy goods. So when we talk about, and when we hear Tiff Macklem talking about that we need to slow job growth down in order to slow inflation down, something, if you're marginal in terms of are you covering your costs of fuel, of food, of accommodations, and paying those higher rents, you don't have a lot of discretionary income to go out and buy more stuff, which in fact drives inflation. So we have to look behind the 150,000 jobs. And when we break it down, we see good news, 150,000 people working. Then we look at the industry and we go, okay, well, nothing in terms of jobs that are high paying jobs that are going to really drive that inflation based on the lack of discretionary income that's going to be driven into the marketplace. Those are kind of surviving based on the fuel again and the food and the cost of housing. So I want to look at a little bit. I got another slide I want to get to in a minute, but back to the jobs. Where did all these people come from? Why are all these jobs here? And this was interesting. This is the quarterly change in net permanent residents. And we can see here, that it really spiked. Well, those individuals are coming into the system. It really drives into the working, and especially the jobs that are there, right? This plays well into these types of non-permanent residents working. So lots of, I don't want to say part-time jobs, they can be full-time, but they're more in the services industry. So those jobs, again, this is a kind of a one-time. I don't think this number will continue. This level of employment will continue. And then finally, what I want to get to is a really important, I think an important slide that says a lot, because this is where Tiff Macklem and Bank of Canada is very nervous. And that is that what drives inflation is wages spiraling up. But when we look at this particular graph back at the end of January 2023, this was Desjardins driven by StatsCan. We start to see the dark green line that you see at the bottom here is really the hourly wages. And what we can see is they actually tick down. As importantly as what we see is that the lighter green line that we see is CPI excluding food and energy. Well, the gray line at the top is total CPI. The point is this: when we're concerned about inflation, we have to look at wages going above that, and they're not. They're actually ticking down. So when we look at the world of inflation, it's actually not happening. So as much as we're seeing people suggest that TIF's going to have no choice but to increase rates, I actually don't see it that way. I think we would be hard-pressed, or Tiff Macklem's going to be hard-pressed to increase rates given what's behind that headline of 150,000 jobs. Now, as we analyze numbers, as we have to make decisions, and we're looking at how we're growing a real estate portfolio, how we're expanding perhaps into our business, we start to understand that jobs are great. At least people are working. And the one thing about working people is that they have a way of just making things work out. So when we look at the possibilities of a recession, I've been saying since November of 2022, November 2022, the numbers just aren't supporting a big recession. Now, I know there's lots of risk. There's the macro political issues that are going on. And we understand Russia, Ukraine, Taiwan, China, what's going on in the UK, and certainly over in Europe. These are all big risks to any economy, but that's a global issue. When we look at Canada and we ask ourselves, are we going to go into a recession? There's no doubt that we will slow down. But at this point, there's no indicators saying we're actually going to go into a recession. I think Ontario's higher risk in that regard. Western Canada still remains strong. Inflation is going to be driven by oil prices. And I'll get into that in another video, because we're going to see oil prices rise. I believe in middle of 2023, we're going to see oil prices rise. That means transportation costs are going to go up, and overall the cost of everything will rise as oil prices go up. So at the end of the day, I don't think we're going to go into a recession. I don't see any panic here, given that we've got jobs, regardless of what we see as the quality of jobs. I don't see interest rates going up in a big way anytime soon, certainly not in March. And I think most of the market is kind of considering that as well. This changed the narrative of what people were seeing, but I think ultimately Tiff Macklem's going to be challenged to increase that lending rate. And that's what I got for you today. Put in the comments below, have this been helpful? Please subscribe to the channel. Let us know what you think. Let me know what you think so I can do more or less of these or expand on them. I know I'll only get better. Thanks for listening.